Hello YouTubers, welcome back to the Independent Investor. This week I'm going to talk about Carnival Cruise Lines. It's the largest cruise ship company in the world, and I've watched it in the past, but it's just been a little bit expensive. I'll go through the technicals first. On the daily chart, it got up to about a high of about $68, and then came right down into the $44 range, and which is quite a sizable correction for the company. And I noticed a triple fan. It's where you trace out the tops of the downward trend, and then the next line is the spot just above that high. And when it you can draw three lines on successive highs, and the share price moves through it. It's usually a pretty good technical indicator that a bottom has been reached. So I did start buying in the about $44 range, and I've added to it since. With the bombing of killing of the general in Iran, that briefly sent oil prices higher. I felt there wouldn't be long-term implications of this, just that Iran's fairly small, and didn't think it was going to really affect the global oil markets that long. Turns out that was true. I used that opportunity when it sold off to buy a few more shares, and at the same time I did a $45 short put out to July and got $2.38. So basically, if the share price stays above $45, then I will not have to buy any shares. If it falls through 45, I'll be obligated to buy those shares at $45, even if it's at 40 or 35. But for taking that risk, I just did one contract, so at $238, one contract's 100 shares, so that was $238. So I look at that as almost manufacturing a dividend, or reducing the price that you purchase the shares at. So now I'm saying if I bought them at 44, I could say I actually bought them at cheaper by $2.38. You can look at it in different ways, but so it has turned around, and it's been trending up fairly good pace. I've got a support line underneath right now, which is about 46. I don't expect the company to have huge capital gains over the next couple of years, but I think it's quite feasible that it could get back into the $70 range, 1 or 2 years out. The big if there is if we don't have a recession. Companies like recreation, leisure, travel are usually the first ones to get affected in a recession. But that being said, we've had Brex in England, and the European economy has also been fairly slow, as we've seen with negative interest rates, and also China's economy has been fairly slow over the last year, and the U.S. market's probably been about one of the quicker economies, but still it's only 2.5%. And that really didn't affect their sales. Their occupancy is actually over 100%. I'm not sure what that means, but every year they're basically 100% booked. So looking at longer term, also this price here coming down, it seems it was two factors. Last year oil prices which of course is a large part of their costs, was you see here, it got up into the $70–75 area, so that affected their quarterly earnings. And also, what we see now, it's kind of went right down to 48, but we seem to be stuck in this 54, 64 price range. And there was a delay on one of their ships coming out, the new ship, the Costa Rica. And but going forward, they do typically rotate their ships out. I think they've got 20 new ships being built by 2025. The older ships they sell off, and the newer ships usually have higher efficiency, so that helps with the fueling costs. Also, they're exploring using liquid natural gas, which isn't as volatile as oil, and would also save on their costs. But if we go out to a monthly chart. Bear with me for a minute here. So many different charts up here. We can see since 2009, the company was at $16 and went all the way up to $72. So it has been a good investment. And I did put a pitchfork on this correction here, and it has broken out of that. And you can see this is actually a sizable correction. And the valuations kind of reflect that with the company. Probably the lowest they've been in 10, 15 years. And there's not been really any change in operations to me to justify that much of a correction. So, and the company does pay a good dividend. It's about 4%. So if we get that 4% a year, and typically company is very shareholder friendly. It's increased its dividends pretty much year over year. The only year it didn't pay a dividend was in 2009 during the financial crisis. And they also buy back shares, but it's kind of a balance between the two. As you know, I'm not a big fan of buying back shares, especially if the company is selling above book value. To me, it's just playing the P/E ratio off against the price to book ratio. So the dividends is the main focus. So again, if we get, even in the next 4 or 5 years, if we just get back to where it was trading, along with the 4% dividend, your total return on capital gains and income could be in the low double digits. And again, this really depends if we stay out of a recession and there's no major financial sell-off or bear market. So, but even so, I don't expect the downside to be too much, just because we've already had that sizable correction. But that being said, depending on how bad the correction is, in 2009 it did drop because it was a recreational type stock. It went from 57 all the way down to 15. So if we did get into a serious sell-off in the market, I would sell the stock, regardless of valuations. So I spent the day going through the 10K for the last 2 years, filled out a spreadsheet that I use. And revenue from 2016 has gone from 16.3 million up to about 18 billion. And shareholder equity has slowly increased. Retained earnings have increased. And because the ships now large ones are about $500 million to $1 billion to build. There is rather large barriers to entry, which keeps a lot of competition out. That's another thing I like with this. And they also do a pretty good job. I might not be able to see it here, but this shows, it's kind of a model I made up of return on assets. So you've got income divided by sales, that gives you your profit margin. And then you got your sales divided by assets, that gives you your asset turnover. So the amount of times you turn over those assets at a given profit margin gives you your return on investment. And the last 3 years, that's been 7.41, 6.48, and 7.98. And what you want to see on that is the total return on assets is actually higher than what they're borrowing money at. And because they're a large international company, they can borrow money around the world, and they borrowed a lot of money in Europe. Some of the floating rate rated actually negative percentage, and the rest is interest rates is quite low. I think I have it written down here. Yeah, so they've got an $860 million loan bond out to 2030, and its fixed rate is 2.4%, and that's the in euros. And they've even got